You've probably heard people say 2008 was the worst housing crash in modern history. However, I want to warn you that what's happening today is even worse. Let me give you some context. Pending home sales just hit a record low, surpassing the 2008 crash. Inventory of new single-family homes have ballooned to the highest level since 2007, right before the crash. But wait until you hear what's causing all of this. Prices of some homes have appreciated in value by over 70% in just a few years, but wages haven't kept up. As a result, credit card and household debt have reached all-time highs. You now need an average income of $108,000 to afford a house, which, you guessed it, is another record high. If I were to create a recipe, let's call it the housing crisis cake. Those would be my main ingredients. The actual truth is that these key indicators like record low sales, record high prices, rising inventories, and rising debt have made it almost impossible for you to buy a home. You can agree this can't go on forever. I'm gonna reveal the data behind why we finally reached the point of no return. Then show you how to protect yourself in this changing market. By the way, for those that don't know, my name's Andy Coleman. I've closed over 900 real estate transactions, making millions of dollars in the last 5 years. I've spent hundreds of hours researching this because times like these are when real wealth is built. If you're looking for an edge just like me, then you're not gonna wanna miss what I have for you today. If you're thinking that the 2008 situation was way different than what's happening now, you would be spot on. To predict what's gonna happen in the future, we have to revisit the past. 2008 was catastrophic. Home prices plunged, subprime loans defaulted en masse. Banks buckled under risky mortgage-backed securities. Millions of homeowners faced foreclosure, which caused a chain reaction throughout the global economy. But let me tell you what's different in 2025. First, buyer behavior. In 2008, distressed homeowners were forced to sell at massive losses when adjustable rate mortgages reset. In 2025, you're not seeing that. Instead, you're seeing buyers strike due to high asking prices and steep mortgage rates compared to overinflated pricing. Many would-be buyers can't or simply won't pay the current premiums, which brought pending home sales down to an all-time low. Second, inventory dynamics. Back in 2008, overbuilding and exotic mortgage products led to a sudden flood of foreclosures, which flooded the market with inventory. Today, we see a surge in unsold homes, but not because of subprime defaults. It's more about inflated listing prices and cautious buyers. Builders are also pulling back because they're sitting on a record amount of new home inventory that nobody can afford to buy. Third, debt profiles. In 2008, mortgage debt was the epicenter of the crisis. In 2025, consumer debt, which is credit cards, auto loans, student loans, it is soared to all-time highs, making it tough for buyers to qualify for mortgages. This is a much different type of problem. Fourth, regulatory environment. Stricter lending standards went into effect after the 2008 crash, meaning fewer toxic mortgages. However, today, rising rates among sky-high prices have locked out first-time homebuyers, potentially causing a slower, grinding downturn rather than an all-out collapse. The real question is, will we see another crash? However, the mechanics are much different this time. Fewer homeowners today are in subprime loans, but more Americans are riddled with consumer debt that could snap under job losses or a sudden economic shock. This market may not implode exactly like 2008 did, but the combination of record low pending sales, overwhelming listings, and debt-riddled consumers could trigger a drawn-out correction, potentially hitting buyers and sellers even worse than it did during the 2008 crash. Think about it. What's the best way to pull off a Band-Aid? Is it slow, drawn out, extremely painful? Or is it sharp and fast? I would argue that a sudden crash actually causes less pain and damage in the long run. So although 2025 might not mirror the sudden subprime meltdown of 2008, it has all the makings of a slow motion crisis. Because we have record high prices, tight credit situations, buyers on the sidelines, and ballooning inventories. Let me explain to you why this could be even worse due to a new record low that we just hit. You might recall that 2008 triggered a crisis, but guess what? The National Association of Realtors just dropped a bombshell. pending home sales sank to the lowest level ever recorded in America. The report details how a 4.6% monthly drop crushed an already weak market, plunging us into territory no one expected to see. Buyers are very clearly on strike, refusing to buy homes because prices remain sky high. You might assume low sales mean you can scoop up a bargain. However, the standoff between buyers and sellers has created a weird stalemate. Sellers are clinging to 2022 era price tags, which was the peak of the market, but buyers refuse to sign unless they see a significant price cut. Maybe you're thinking that you should wait to buy, hoping sellers will cave soon. But if you don't see this next piece of data, you'll have no idea when that might happen. I want you to imagine an entire neighborhood sitting empty, but with for sale signs growing like weeds. Reports show in the Sun Belt region, states like Florida and Texas's inventories are exploding. In Florida, active listings soared 34% year over year, topping 168,000 units, which is the highest it's been since 2016. Texas just saw a 25% jump, pushing over 105,000 active listings. Buyers have vanished, leaving owners desperate for offers, yet they're not dropping their prices fast enough. This meltdown in the South is dragging the national average into record low pending sales. But even if you don't live in the South, this still matters to you. The South is the largest housing market region in America, so a slump there can destabilize the entire country. People might pack up, moving to other states, causing a sudden influx like we're seeing in the Northeast. If you look at states like New York and New Jersey, you can see they have a much different problem. They have no inventory. Their prices are rising by the week because sellers are getting 30 offers within 2 days of listing their home. In the West, states like California are seeing something very similar, just not as extreme. So depending on where you live, you might think cheaper homes are coming, so you'll just wait. But the question is, when? You have to take it in consideration if inflation keeps going up along with the sudden interest rate hikes or the jobs market suddenly shifts, you're gonna see a panic in the market, causing everything to come crashing down. That's exactly what happened in 2008. But we haven't even gotten to the scariest part yet. Newsweek's latest article on developers halting or scaling back future projects is a very bad sign for the housing market. New houses for sale are already at the highest level since 2007. Builders are sitting on unsold inventory, offering mortgage rate buydowns, flashy incentives, and deep price cuts to move these properties. But they still aren't luring enough buyers because people know it's cheaper to rent the same equivalent house than it is to buy, which is great news if you know how to use this information, because a surplus of new homes can drive down existing home prices even further. But if you buy too soon without factoring this in, you're gonna have negative equity if the home's value drops after you purchase. Think about how many people were underwater after 2008 happened, getting completely wiped out. So you're gonna have to ask yourself if you're willing to face that risk. But if you think that's the biggest problem, it gets worse. Debt levels might be the real ticking time bomb. You've probably seen all the headlines by now. Fox Business reports that consumer debt, which is your credit cards, auto loans, and personal loans, just hit an all-time high. Data shows a surge in delinquencies, bankruptcies, even the beginning of foreclosures. Depending on the house price, for each 1 percentage point mortgage rates go up, it could affect your monthly payments by hundreds or even thousands of dollars. Since mortgage rates have gone up, fewer buyers qualify under banks' stricter guidelines compared to before 2008. But think about it like this. If your income increased at the same rate as inflation and these record high housing prices, you wouldn't be in this mess. However, your wages have not gone up by nearly enough to fill the gap. You can't absorb these higher home prices no matter how many mortgage buydowns you're offered. You might have enough for a down payment, but your monthly debt could block you from qualifying for a decent mortgage. That makes me think, if the average borrower is strapped with mounting debt, what happens once job growth slows or unemployment rises? We risk a full-blown repeat of the worst moment during 2008. Probably even worse, because consumer debt is at record levels. Now, this is where things start to come together, so listen to this. The median home price in America now sits at $420,000. First-time home buyers need a median income of $97,000 just to afford the most worthless piece of trash you can possibly find. Because of this, first-time home buyers buyers have shrunk to all-time historic lows, making up just 24% of sales. But do you know what monthly payments look like when factoring in your 8% down payment, taxes, interest, insurance, etc.? Very close to $4,000 on an average priced $420,000 home, not including maintenance or utilities. All the while, you can rent the exact same house for $1,000 less per month and not have to put your entire life savings on an asset that's not really a good investment to begin with. I made an entire video on why renting will actually make you way more money in the long run than buying, which I'm gonna link at the end of the video. But I don't want you to lose hope. There are strategic moves that you can make right now. Crises like this create opportunities if you're well prepared. Here's my tips. Build your cash reserves. A, you want a cushion for yourself if you lose your job or a big medical bill hits. B, if the market does suddenly crash, you're gonna need liquidity to invest. A 3 to 6 month emergency fund probably won't be enough, so I would aim a little bit higher, maybe around 9 to 12 months. Second, get out of debt. You can lower credit card balances to improve your debt to income ratio, because if your credit score and your credit history is strong, lenders are going to be more willing to negotiate better rates or terms once the market dips. Third, negotiate like never before. When the timing's right, you might be able to get mortgage rate buy downs or closing cost assistance. So ask for it. Sellers are also offering price reductions, so don't be afraid to push for additional perks if you see multiple listings sitting unsold. Fourth, stay open to different markets. If you're not tied to your home state, you could look into other regions. Some cities aren't as overvalued as others because you can scout those areas out for better long-term growth or less competition. My fifth tip, time your purchase wisely. This is by far the most important. You don't need to wait for absolute rock bottom prices. Those are only visible in hindsight. But if everything keeps trending down, you can negotiate with strong confidence. Keep an eye on local price cuts, days on market, and inventory levels. If they spike, you might leverage that to get a killer deal in the coming years. Now here's my prediction. I predict in 2026, that's gonna be the best buying opportunity because they're gonna start dropping mortgage rates after inventory levels peak, causing home prices to start to come down. Because throughout history, times like these are when the most new millionaires have been made. Now, let's summarize everything we went over today. You've discovered that 2025 differs from 2008 in crucial ways. Less subprime chaos, but more consumer debt and a buyer's strike. National pending sales just hit an all-time low. The South is dragging down the entire market with ballooning inventories in states like Florida and Texas. Builders are waving the white flag by pulling back new projects, even though they're stuck with record new home inventory. Debt levels stand at a record high, but first-time home buyers have fallen to their lowest level ever. But you can still seize these opportunities by safeguarding your finances, refining your negotiating tactics, but most of all, watching key local indicators. This all might sound terrifying, but knowledge is gonna give you a massive edge. If you found these insights valuable, I'd love to hear your perspective in the comments. I spent a tremendous amount of time on this video. Please do me a favor by sharing it with anybody that you might think needs to hear this, and just drop me a like. But if you wanna see why renting a house is actually a better investment than buying, click on the video above.